You know, when we talk about digital currencies, it's so easy to get caught up in this idea that they're here to completely replace centuries of financial history. But what if that's not quite the right way to look at it? What if, instead, what we're really seeing is some incredibly powerful new tech trying to solve the very same problems we've always had with money? Now that's the story we're going to dig into today.
Okay, so here's our game plan. First, we'll rewind and look at the big debates that have always defined money. Then, we'll see how crypto just brings those classic arguments about value and trust roaring right into the 21st century. After that, we're going to unpack how digital currencies are totally reinventing scarcity and stability. And finally, we'll look at the tough new choices this technology is forcing all of us to make.
All right, to really wrap our heads around cryptocurrencies, we have to go back to the beginning. We really need to understand the fundamental trade-offs that have shaped every single form of money that has ever existed.
The entire history of money has basically been a giant tug-of-war between two big ideas. On one side, you've got this disciplined, scarce money, right? Think gold. Its supply is just fixed by nature. And on the other side, you have flexible money, controlled by an institution like a central bank that can tweak the supply depending on what the economy needs. This clash, this fundamental conflict between discipline and flexibility, that is the key to understanding literally everything that follows.
So, where does crypto fit into all this? Well, here's the thing. With its arrival, these classic arguments haven't gone away at all. They've just been rebooted for the digital age.
And this is the perfect example. There's a really good reason people call Bitcoin digital gold. Just like gold, its supply is mathematically limited, and it operates completely outside the control of any single government. That classic tension between scarce physical gold and flexible government-issued fiat money, it's playing out all over again, but this time it's happening in the digital world. But here's the big twist. Unlike gold, Bitcoin has no physical form. You can't use it in jewelry or electronics. So where does its value come from? Well, its supporters will argue that the value is in the network itself, its usefulness as a global, censorship-resistant, person-to-person payment system. And this forces us to ask a totally new question. Can the usefulness of a network, all on its own, be a new kind of value?
Now, to understand the alternative that crypto is proposing, let's just quickly define fiat currency. Think about the US dollar or the euro. They aren't backed by a physical thing like gold. They only have value because a government says they do, and we, the people, trust that government to keep its economy running smoothly. The most important thing to get here is that its entire value rests on trusting a small group of people in a central institution.
And this brings us to the absolutely fundamental shift that cryptocurrencies are proposing. See, the fiat system asks you to trust people. Politicians, central bankers, who, let's be honest, are vulnerable to mistakes and policy changes. Crypto offers a pretty radical alternative, a system where you don't have to trust people at all. Instead, you trust the code, the open-source math that anyone can look at and verify for themselves. It's a huge shift from trusting people to trusting protocols.
Okay, so keeping that new model of trust in mind, let's see how the crypto world takes on those other classic money problems, how to manage supply, and how to make sure things are stable.
In the fiat system we have right now, central banks have a really powerful tool. They can increase the money supply pretty much whenever they think it's necessary. This policy, which you might have heard called quantitative easing or just money printing, gives them a ton of flexibility. But it also means that a very, very small group of people has the power to change the value of all of our money.
Bitcoin's monetary policy is the exact polar opposite. It is programmatic, it is predictable, and it is unchangeable. There will only ever be 21 million Bitcoin. That's it, full stop. This is a deliberate return to the idea of absolute scarcity. Kind of like gold, but this time, the limit isn't enforced by geology. It's enforced by pure code.
But what about stability? We all know crypto prices can swing like crazy. To solve for that, the crypto world came up with stablecoins. These are digital tokens designed to hold a steady value, usually by being pegged one-to-one to a big currency like the US dollar. You can think of it like a digital voucher that's always supposed to be redeemable for $1. It's a way to bring a little piece of the traditional financial world into the digital one.
But here's the catch. That digital peg is only as strong as the trust behind it. If even a tiny whisper of doubt gets out, a rumor that maybe the stablecoin isn't fully backed by real dollars, confidence can just shatter in an instant. This is what triggers a digital bank run. Everybody rushes to cash out at once, the reserves get drained, and that one-to-one peg breaks, leading to a total collapse. We saw this exact scenario play out with the fall of Terra USD.
So this all leads us to our final section. The core design challenge of these networks brings us a modern version of that classic trade-off between stability and flexibility we talked about right at the very beginning.
It's called the blockchain trilemma, and what it says is that it's incredibly hard for a network to be decentralized, secure, and super fast, or scalable, all at the same time. You can usually pick two of these properties and optimize for them, but you almost always have to sacrifice the third one. Bitcoin is the perfect case study for this. It prioritizes decentralization and security above absolutely everything else, which is what makes it such an incredibly robust network. But the trade-off is scalability. It just can't process a huge number of transactions very quickly. And that is why using the Bitcoin network can sometimes feel slow or have higher fees compared to something like a credit card swipe. It's a deliberate design choice. Sacrifice speed for maximum security.
So here's the big takeaway from all of this. Digital currencies haven't ended the story of money. They've just kicked off the next chapter. And it's not some straight line of progress. It's more like a cycle. We're using these incredibly powerful new tools to wrestle with the same timeless questions of scarcity, trust, and stability that we've been asking since the dawn of commerce. And that leaves us with one last fascinating question to chew on. For generations, the rules of money have been written by governments in law. But now, for the first time, we have a competing system where the rules are written by developers in code. So which one is going to define our future?